Hello everyone. Welcome to Principal's Q3 2024 Market Outlook. My name is Fartini and I'm your moderator. Now before we start our discussion, I'm pleased to introduce you to our panel experts, and they are Mr. Jesse Liu, CIO of Principal Southeast Asia, and Mr. Lee Chun Hong, CIO Malaysia for Equities Malaysia. Now on that note, let me just start with Chun Hong. The second quarter of 2024 has just concluded. We've observed notable developments, including the ongoing moderation of inflation and potential changes in the policy pathway, with Eurozone recently made the first cut in June. Developed markets have shown resilience despite ongoing uncertainties. The US economy remains strong, Europe avoided a recession, and China signals a recovery. In Asia, Taiwan, Vietnam, and China offshore have emerged as strong performers. So on that note, Chun Hong, can you share your thoughts regarding the equity market in the second quarter?
Okay, thanks, Fatni. Thanks for the question as well. So yes, you're right. So the global equity has continued to register and posted a positive growth in the second quarter. And these are led by tech, and India, and China. As for the tech, as you know, NVIDIA is a poster child for generative AI. So the recent results continue to show a very strong growth and actually surprise to the upside. And this caused the whole tech sector, in particular that are exposed to semicon and generative AI, continue to scale new high. Okay, and as for India, investors continue to like the structural growth story in India, largely due to the reform that carried out by Prime Minister Modi in the past 10 years. So despite the recent election, Prime Minister Modi won with a lesser vote. Nonetheless, this reform is here to stay. So that's why India continues to scale new high. Whereas for China, as you know, in the past 3 years has been the doldrum. And of course, in other words, also the foreign equity or ownership of China markets should be at a historical low. And post-Chinese New Year 2024, the Chinese government actually pay more attention to the economy and also the stock market. And it's because of that, they also signals some form of policy easing in property as well. So this one caused the investor to reduce their underweights and position on some of the names that continue to show growth in internal earnings. Yeah.
Thank you so much, Chun Hong, for your perspective. Now, Jesse, let's hear your take on the fixed income market in the second quarter.
Right. So if you look into the fixed income market, initially, I think market really came out from the first quarter, whereby there was a lot of euphoria in the beginning of first quarter, saying that there's going to be a substantial amount of rate cuts in 2024. But that didn't quite pan out, as you rightly pointed out. As the data came in, slowly but surely, investors start to reprice the entire bond market. So if you look at US dollar denominated bond market, it is a tad weaker. In terms of performance, it's about neutral. The repricing of rate cuts actually resulted in bond prices becoming weaker in the second quarter, but that was cushioned by the coupons that's being collected by those bonds. So in that sense, I think the neutral performance is something that is not unsurprising given that repricing. But I would say that if you look into other markets like Malaysian markets, for example, we have a much more stable policy rate outlook from investors. So if you look into local currency bond performance, Malaysia is roughly stronger as compared to US denominated bonds, unhedged, on an unhedged basis. So if we look into this kind of outcome, it's not something that we've not foreseen. I don't know. I think, in our last recording, we did pointed out that if there were a bond market that we want to favor, naturally we want to favor the local currency ones, and in particular in Malaysia this time around, because again, we do see more stability in policy rates.
Okay.
Yeah.
All right. So we're going to move back to Chun Hong. Yeah. Considering the recent rally in growth assets, such as in the small, mid-cap and technology spaces, primarily driven by the AI story, do you anticipate the current market leadership to shift? Does this segment still provide a reasonable risk-reward profile, in your opinion?
Okay, thanks. Interesting question, but let me remind the listener, equity is all about growth. So the investor will look for growth whenever they can provide in equity market. So for Malaysia's case, the KL Tech Index has been in the doldrums since 2021. And in 2023, everyone was waiting for some form of recovery. It's been delayed quarter after quarter. And latest result showing that, sign of bottoming. Whereas for North Asia Tech, as you know, that we turned positive towards the end of September. And the market actually bottomed for the North Asia Tech, and namely the TSMC, SK Hynix, and Samsung Electronics. And the recovery continued. And of course, talk about generative AI. It was something new towards the late last year. And the rapid adoption are spurring the demand for semicon chip further from here. So we think that generative AI is here to stay for a near term to a medium term, as more equipment are being used through AI. So this will continue. So with that, we hope that KLCI Tech will see a recovery towards second half of 2024. So regarding whether it's expensive or not, looking at the index, it's still about 24% below the all-time high registered in 2021. So we think that valuation is decent. And with the generative AI here to stay, we think that investor would try to sniff out stock in the tech sector that can generate growth in Malaysia. So we think the risk profile is still favor the upside than downside. Yeah.
Thank you for that. Now, Jesse, we've witnessed some volatility in the US bond yield, particularly in response to the recent US data, which showed resilient growth comes with resilient inflation. Do you think central banks will be willing to tolerate some overshoot of their targets? What are your thoughts on future policy rates for the US central bank, as well as other central banks like Europe and Japan?
Right. So if I were to look into the data that's been released, of course it surprised the central bankers quite a fair bit, especially in the US. But I would say when we look into data, it's not surprising to have a little bit of overshoot and undershoot. The question is really much more about whether they missed by a whole lot, like what we saw in 2022, whereby if you see inflation suddenly spike up to 9% thereabouts for the US, I think that would be a major concern, right? But having said that, this time around, yes, we do have a slightly stronger duration, but inflation. But we are not talking about those that is runaway, like 9%, 8%, those kinds. So that overshoot or even some undershoot in the coming data, I would say it's nothing of a surprise. If given that scenario where we're going to witness a little bit more overshoot, undershoot, I don't think it's going to change a lot of base case on our side. We're expecting about 2 cuts still for the US in 2024. Maybe if inflation continues to print slightly stronger or overshoot in your terms, in the rest of 2024, maybe we can revise it down lower to about 1 cut. But I think these adjustments are quite understandable in that sense. If you look into the Euro area and also in Japan, maybe I just touch a little bit about Euro. I think they have a bit of a different dynamics, considering that inflation dynamics are different. The economy, some of the European Union economies have gone into negative growth. So in that sense, I would say that policy response between Europe and US would also be very different, or slightly different, not very different. I don't think that it can be very different, largely because, for example, US and Europe are still large trading partners. If the policy rates can be different, the change in currency can also become an issue, whereby then Europe might start to face a little bit more, say, imported inflation from goods coming from the US. I think the last thing that Europe really wants is to have a slow growth and high inflation in that sense. So policy rates might deviate somewhat between Europe and US, but it shouldn't deviate too much per se, largely because there are other things that's in play when policy rates are very different from region to region. In Japan, of course, they are on a totally different pathway compared to US and Europe. They recently just hiked, as you know. But I think for Japan, it won't probably it won't change too much from where it is today.
Okay. Thanks for your perspective, Jesse, on that. Now, let's discuss the Asia-Pacific region. There's still a lot of anticipation that Asia recovery will be ongoing, considering that the market recently rebounded from the lowest point, and the 12-month forward earnings estimate suggests potential upside with Korea and Taiwan expected to lead the way. Now, Chinese authorities have also recently suggested more policy support, including measures focusing on addressing the ongoing property market situation. Chun Hong, what are your perspectives on this situation? Can we expect a significant upswing in the near future?
Positioning-wise, yes, as mentioned. I mean, generally the investor has been underweighting China market because of the underperformance and also the, lower than expected policy support from China. But of course, yes, as mentioned earlier, post-Chinese New Year, Chinese government become more serious about economy and also the stock market. But whatever policy support that they just announced recently, we reckon is still not enough to actually boost both the business and consumer confidence. We reckon they should do something more creative, something that most people won't expect the Chinese government will do it, as in like giving cash handout to the population, buy out the property company or developer. Yet to be seen whether they are going that direction, but so far their focus is mainly on the manufacturing side. You can see that they're the largest solar panel producer, they are largest electric vehicle producer, battery in the world. So they are focusing on that part of the economy and not so much on the domestic part. So they need to do something to boost the confidence. But underlying property demand is there, judging from the healthy secondary market. So the secondary market, as long as the property is in the good hand and good condition, they are able to sell. So it shows that demands are there. It's just that the primary market, as in buying directly from the developer, the demand is not there, except for those supported by the government. Yep. So because of the ongoing balance sheet recovery or repair that's happening at the moment. So this one will take at least another 6 months to 12 months, unless the government come in and just do something unexpected. Yeah.
All right. So now, Jesse, turning to the Southeast Asian bond market, are you anticipating any major shift in ratings in the regional and local market? Additionally, how do you perceive the context of issuance and trading volume evolving in the Malaysian bond market in the near term?
Okay. So when it comes to policy rate, we don't expect big changes. I'll probably just touch on Malaysia. In that sense, I think inflation has been very much contained. We are not more than 2% by and large, and we've got pretty much strong growth that's coming in. So I would say that there is no reason, no big reason right now to really move policy rates. So in that sense, if there's anything on the Malaysian bond market, probably there will be influence from outside of the country, namely how US Treasury would trade. But at that same token, I would say also that the volatility in Malaysian bonds and US Treasury bonds, US Treasuries, they are not like for like in that sense. I would say that Malaysian bonds would probably trade at a much tighter range compared to the US counterpart. As for trading volatility or trading volume or demand for bonds, I think it's still a very healthy environment right now that we have here. We can see that demand is really coming in, not only for pension funds or even the banks. We can see a lot of technical demand coming from repatriation of cash into the economy here. So risk assets for Malaysia as a whole has enjoyed this shift in technicals, and you have seen very strong performance for not only just the bond, but also for the equity asset class. So I would say, and to add on, when we look into the tenders, the government bond tenders, and also demand from corporate bonds, they continue to be very strong, very healthy. Because you have good growth in the economy, we don't think there's going to be major shift to Malaysian fundamentals by and large. So when you have all that checked in, I would say that Malaysian bond markets will probably continue to sail along, relatively stable in second half. So I think it probably is continue to be a good market to be in. What I would add is that, like I mentioned earlier, let's say if the Fed has already repriced policy rates from 6 to 7 cuts early in this year or late last year to now 1 to 2 cuts for the remaining part of the year. So I think in terms of that repricing, probably it won't make a lot of changes anymore. And if that plays out, if you have more stability in the US bond market, probably that will continue to be a positive influence to the Malaysian bond market in that sense.
All right.
Yeah.
Thank you, Jesse. Now, as we wrap up today's discussion, let's get some advice for our clients regarding the asset allocation for 2024. Let's start with you first, Jun Hong, and then we'll have Jesse's perspective.
Okay, Ken, just to share our view that our in-house view has upgraded equity from balanced asset allocation between fixed income and equity since April. And likely so, the equity market has performed relatively well. And similarly, in Malaysia also, we continue to be very positive on Malaysian equity in the near term to medium term for the rest of 2024. So right now, we have a slight preference of equity over fixed income. Yeah. I'm not sure whether Jesse agree. Yeah.
Jesse?
Yeah, I do. So clearly, when we look at absolute performance, equity has outperformed fixed income. But I think, again, fixed income is an asset class whereby it is anchored well for investors' portfolio. If you have a component that is in fixed income, it will anchor the vol for your portfolio. So I think it continues to be key. Furthermore, it really depends on where you can allocate your funds. If you are keen into, let's say, US dollar, short duration kind of strategy, it would help you because of the inverted yield curve in the US. So that is very helpful. But, back to asset allocation, I would say that data in the US continues to come in. Again, to your point, overshoot, undershoot. If, let's say, you're talking about a much more overshoot kind of a situation, like I mentioned earlier, maybe the market's pricing 2 cuts for the year reduces to 1 cut. So in that sense, you will probably see US bond performance a bit lagging over there. Again, back to the point where I made actually from last quarter and until now, we don't think there's going to be much changes to Malaysian central bank policy. So again, I don't think that we're going to make significant changes on our asset allocation call for local currency versus US dollar currency bonds. We still favor the local currency ones, largely because of the stability. And I think it'll probably play out in second half too.
Okay.
Yeah.
On that note, I want to thank both Jesse and Jun Hong for your insights and perspectives today. So there you go, ladies and gentlemen. Thank you so much for your time. We hope that you find our insights and perspectives today helpful and it help you to achieve your investment goals. Thank you.